All right, guys, I'm excited to show you my recording of the conversation we had with Yonah Weiss. This one is about cost segregation, and I know that especially if you're my client or you know anything about real estate investing tax strategies, I'm sure you've heard about cost segregation. And in the first few minutes, we talk about some of the basics, but then we dive into a lot more detail, so stay tuned. Even if you're one of our clients and know about cost seg, stay tuned and you're going to get some great nuggets of information. Some of the things we talk about are what type of investments are going to create the most bonus depreciation after we've ran the cost segs. And then I kind of riff a little bit on what do we do after we've ran the cost segs, because tax planning for real estate investors or any type of clients is about more than just doing cost segregation studies. We want to look at all of your sources of assets and income, current income and potential future income. And by doing this and evaluating all the current and potential future taxable events, we can do some strategizing and take advantage of you being in potentially a lower bracket with a cost seg, and think about the timing of all different taxable events to really set you up for success, not just to save money in the current year, but also create future tax savings in the future based on the actions we've performed in the current years of those cost segregation studies where we get the 100% bonus depreciation. So stay tuned, there's a lot of good information here, and we talk about the future of what we're going to see in the future as bonus depreciation phases out. And we're also going to discuss some of the things that Yonah Weiss has done to really make his name synonymous with cost segregation. Most of you guys have heard of Yonah Weiss if you're interested in cost segregation and tax strategies, but if you haven't, this guy is practically synonymous with the phrase cost segregation, and he has really built a strong brand and name for himself by generating lots of content, lots of networking, and just being a great resource. So he talks a little bit about that and his journey as a businessman and a subject matter expert. So even if maybe you know everything you know, but you're still trying to build your brand, you might get some good insight on that topic as well. Yonah Weiss is world class at this. So stay tuned. There's going to be some great stuff. Subscribe to our channel and our podcast. We have great stuff coming your way, and I hope you enjoy this conversation.
All right, cool. So let's get started with our conversation. And Yonah Weiss, thank you so much for joining us today. For those of you listening live and those of you listening to the replay, Yonah Weiss has been a fantastic resource for me and like the whole world of real estate investing. He is. I've never seen anyone more synonymous with the tax strategy than Yonah Weiss. I call him the man in black. He is the cost seg king, and he talks all about cost segregation. What's interesting about you know, I want to talk about more than just cost segregation and real estate and taxes. So we'll talk about how you've built your brand, and I'm interested in how you've networked and done all these awesome things. Yonah, to me, you were like, I remember you were like Lil Wayne in the early 2000s. Like whenever I would hear rap music, Lil Wayne would show up. He was like in everybody's song. He knew everybody. He did cameos everywhere. And eventually you're like, who is this guy? And like you knew everyone on LinkedIn that I had connected with as a real estate investor. And I eventually said, who is this guy? And this was a while ago where I had like maybe 3 clients, and you gave me an hour, a good amount of time. And I really appreciated your generosity at the time. And the plan involved a cost seg. Unfortunately, the deal didn't go through, but you helped me out with estimating the losses we could have created with the cost seg and the write-offs.
Right.
And since then, Yonah's been a really great resource and colleague. And today we're going to talk about cost segregation and some ways that we can use it and take advantage of that, and some other strategies we've seen. And Yonah, in your own words, can you introduce yourself in 60 seconds or less?
Absolutely. Well, first of all, thank you so much, Mark, for hosting me. Very kind words. And a great analogy, Wayne. I never would have thought of that one. But it's like, if you put yourself out there, this is a really great way to kind of brand yourself, and something that, yes, it's true. I did, and showing up on podcasts and being very active on Bigger Pockets and all the different social media for especially LinkedIn was extremely beneficial. So for our business, and I work for a company called Madison Specs, we're actually the largest national cost segregation company. And I found early on in working for them about 5 years ago that very few people knew what this thing called cost segregation was. So my background is in teaching, and I basically took upon myself to just spread the word and talk about it to everyone far and wide. So that meant going on podcasts, that meant doing webinars like this or others. And since then, I've done over 300 podcasts, and that's before hosting my own podcast, Weiss Advice. And that's what we're doing. Madison Specs has to date done over 20,000 cost segregation studies across all 50 states and every asset class, and just happy to be that industry expert and showing up just to add value to everyone where I can.
Yeah, awesome. And so, we'll talk a little, let's talk in, I'm sure I talk about cost segregation every day of my life.
It makes two of us.
I talk about cost segregation more than my family, more than my cat. But to maybe a beginner audience, can you give us maybe a very quick overall summary of what cost segregation is?
Absolutely. So you being a CPA, you're talking about cost segregation because it's a tax strategy. And, not all CPAs are familiar with all the tax strategies out there, especially those that are related to real estate, because there are many CPAs that are just, number punchers. They're just plugging in numbers. But someone who's actually taking a proactive role to try to have a little more strategy involved, that's something that you do. So cost segregation is I don't know if you can hear those parakeets chirping over there, but I think I need to put them to sleep because they're making a little noise. Huh?
You're fine. I don't think they weren't too bad. I heard them a little bit, but
okay. I was trying to call someone to put them to sleep or something. I had one time I was doing a webinar and someone's like, tapped in the chat, whoever's birds are chirping, please mute yourself. I'm like, oh, that's me. I was giving the webinar. So if you guys hear the birds chirping, I'll have to get them quiet. Anyways, cost segregation is a tax strategy that allows you to take depreciation deductions at a faster rate. So essentially taking from the pool of potential depreciation deductions, instead of taking a little bit each year, you have an opportunity to tap into those deductions and pull forward a lot of them so that you can use this tax strategy to get more deductions up front. I mean, as simple as that. It's done through a very detailed engineering report of the property that breaks down the property into its individual components. But in short, it's a tax strategy that allows real estate investors to get more deductions in the early years of ownership.
Right. Absolutely. And so what we do with our clients is we take real estate assets, and we look for opportunities where those losses are valuable. And what we can do is, if we can treat your losses as non-passive, then we will accelerate the depreciation, and then with those non-passive losses, use them to offset other sources of active income, such as that from your W-2 or 1099 income. And so the two ways we can do it: real estate professional tax status. If you work full-time in real estate, there are other variables, but I don't want to take you down too many rabbit holes. Or if you materially participate in a short-term rental and the average length of stay is 7 days or less, you want to see a decent amount of purchase prices and basis in the property to justify that, so we can create enough tax savings to justify the extra procedures and the prices for the study. Now, so when we think about the value here, let's break down the numbers here. What's a good way of estimating? My rule of thumb has typically been around 25% to maybe 30% for some of the properties that have a little more unique features that'll qualify for more personal property in the properties, like short-term rentals come with furniture. So we add another 5% to our estimates. But what do you typically see, and how would you potentially estimate how much is going to qualify for this bonus depreciation that we write off immediately with cost seg?
Yeah, so we always like to do a free estimate up front so we can show the potential tax savings. But you're absolutely right, especially when we're dealing with short-term rentals. We have a lot of furniture, fixtures, amenities, and that's what we're doing with the cost segregation. As you mentioned, the bonus depreciation, the upfront write-offs are based on that personal property, the property that depreciates on a 5-year schedule. So it is on average, probably for the short-term rentals where you actually own all the furniture, probably around 25% is a pretty good rough number. And so that allows you to take, if you buy a property for $500,000, I mean, you're talking about, after you're taking off a small amount for land, you're talking about maybe $70,000 to $100,000 right up front of tax write-offs. So, I mean, that can be a huge game changer to lower your taxable income and potentially, have losses that can carry forward or can be used against other income.
Yeah, so here's some things we want to think about too. So there might be some instances where you might be a little disappointed by your depreciation, and that might be if you are investing in an expensive area, like if you're investing somewhere on the west coast of California on the beach, or an expensive fancy beach town. What's going to happen is when the appraisal comes in, they're going to assign such a high value to the land. There's not going to be a whole lot of additional building basis for you to get those write-offs. It still will likely be worth it, but that's an instance where the amount may go down. And here's something really cool, though. I mean, this isn't involving cost seg, but there's something called a C-store. And basically, if you are what the IRS calls something along the lines of like a distributor of fuel, you could potentially write off 100% of that building in year one without even doing a cost seg, which is pretty awesome as well. At the end of the day here, the opportunity when you own real estate and buildings is the massive amount of depreciation that comes out of that you can write off. Even if you're financing the building, you're still writing off oftentimes more than you're putting down into the property. So
yeah.
One of the things, thinking about how the numbers play out, one of the things we've been chatting about is, what type of assets potentially can create more write-offs than others, what kind of buildings, and what have you seen with mobile home parks?
Yeah, it's an amazing thing. Mobile home parks are one of the interesting asset classes, and RV parks as well, that allow you to take a huge amount of bonus depreciation. So when you think of mobile home park or mobile home community, whatever you want to call it, you're like, well, what do I even own? Oftentimes you're buying a property and you're like, well, it's just land, especially if the tenants own all their homes, which is very often the case. But what you're not thinking about is that there's a category of depreciation called land improvements. And so that's what's on top of the land. And if it's paved roads, you have concrete pads under each home, you have landscaping, fencing, water drain systems, et cetera. All of that stuff is considered land improvements. And essentially, that's the majority of the value of what's going into the property. That being said, there's also an opinion, which not all accountants will agree upon, but there is some tax literature surrounding this, that some consider the mobile homes themselves as 5-year personal property, which means if they are, still considered quote unquote mobile, meaning if they still have the wheels on them and you just pull back the skirt and you can see they are potentially movable, you can be treated as 5-year property, which means you could potentially have, besides the land allocation, which, again, can be 5%, 10%, 20, 30%, whatever that is, the remaining basis can literally be, 80%. And I just did one today where they had literally 88% of the tax basis was going to the bonus depreciation.
Oh my God, 88%?
Yeah, it's pretty wild.
So,
but there was like very little structure. The only thing that was going to the 27.5 year schedule, which is structures, there were no structures on the property that were owned, but the only thing that was going to that is the infrastructure utilities. So like the water lines, the gas lines, septic and electric lines, those are considered infrastructure. The value of those per square footage or per unit is going to be what the only thing that's going to be in that 27.5-year depreciation schedule.
Wow. So imagine you put $200,000 down into a $1 million property and you write off $887,500 in taxes. That's that's crazy. Imagine let's say you're in a 30% federal tax bracket. So it's like your deduction is more than your down payment. I mean, your refund that you can generate is more than your down payment here. Or like, break those down. Let's say you put maybe not 200, but let's say, you put $50,000 down and just, shrink the numbers in proportion here. But like, that's incredible. And when you think about the compounding of your wealth, you get your money right back in the form of a refund. The BRRRR strategy is really popular where you get your money back in the form of refinancing, and you can still refinance too. So you get your money back in the refund and in the form of doing a BRRRR and improving some of the valuations there as well, which is just amazing.
Yeah, it's incredible. And, to think, especially when you're giving the, as you mentioned before, the real estate professional status, where you're able to use those deductions against any other source of income you have. It's not just about creating these losses, it's about actually, saving a huge amount of potential money that will be going to Uncle Sam that you can use that to reinvest and, just buy another property. I have plenty of clients that they tell me the amount of money that I saved on using the cost segregation, they were able to put a down payment on another property. So that's just incredible. Yeah, and to me, that's really the purpose. So if you take your tax savings and you say, "Oh, I'm going to be rich," and you buy yourself a Lamborghini and a fur coat, you're losing future depreciation. So if you're not putting that money back into your business endeavors, you're going to find yourself with less write-offs in the future. But if you're smart, you put into more real estate, and that gives you more depreciation. You run more cost segs, and you see that compounding long-term growth of your wealth over time. 100%. So another thing we didn't talk about, which is interesting, is not as common, but we have taken advantage of this with clients. So let's say you don't have real estate professional tax status. Let's say you don't have short-term rentals. How can we also use cost segs? Well, there are two other instances that I've seen. One is if we have the rentals operating at a profit where the revenues exceed the expenses, after we've looked at how all the numbers come together, we can use the cost seg to offset the taxation on their rental portfolio. So sometimes we see this if you have a collection of older properties, or you're a wholesaler and you get some cheap $30,000. You have wholesalers getting houses for free. I'm like, you guys are killing me. So those are instances. And then another thing that we've seen is if you have other sources of passive income. So, if you are a passive partner in a partnership, it can't be a husband and wife because of the attribution rules. But let's say I had a client who was a partner in a tech startup. And part of our tax plan was, first we realized that the prior accountant misclassified his income as active, but it was passive because he was a passive participant. He didn't materially participate. So we reclassified his income from active to passive. And then we ran a cost seg on his long-term rental, no rep status, but we still use those losses to offset the profit that flowed through on his K1 from the partnership income. So not only did we eliminate the payroll tax with the prior accountant had it taxable and with payroll tax because he thought it was active income, we classified it as passive, and then we use the real estate laws to offset the passive, and we saved, I believe it was tens of thousands, and we'll save him hundreds of thousands of dollars with these strategies. That's pretty awesome. And that really just goes to show you when you have a CPA like yourself that's being proactive and figuring out the different ways that we can utilize and the different strategies we can utilize. It may not be just cost segregation, but it's combining with other things as well to make sure that the individual has the best way that they can reduce their taxable income. Love that. Yeah. So let's talk about another thing that is, because I know that I talk about cost segregation all the time, and it is really widely known. So I want to talk about some things that people talk about a little bit less. So in addition to reducing our taxes, obviously, from the write-offs we generate,
we also can consider cost segregation as a valuable tool when we dispose of the property. Remember that we are, there are some tax traps with depreciation recapture, but also because we have assigned a valuation to these individual property items in the real estate. When we look at the recapture, we can sometimes mitigate some of that recapture by reevaluating the value of certain items that have never regained their value in the asset. I'm not sure if I explained that so well, but Yonah, maybe you can explain some examples of what you've done to help with eliminating the recapture tax on some of these components we've identified with the cost segregation study.
Absolutely. Absolutely. So this is a strategy called partial asset disposition. And this is something that, think of it like this. Once you've done a cost segregation and you've shown what the actual value of those individual components are. So let's say you have, I don't know, a refrigerator, okay, appliances, whatever it is, and you allocated, $5,000 to your appliances. Well, that's showing from a tax perspective that it's being depreciated on a 5-year schedule. Or if you're taking bonus depreciation 1 year, what happens in 5 years from now when you sell the property? Normally, you would have a depreciation recapture tax on whatever amount of depreciation that you took. And the recapture tax rate on those items that are accelerated depreciation, like the appliances, is going to be at your ordinary income tax rate. However, since you've already shown that there's no value, because from a depreciation standpoint, it's already been fully depreciated. So now when you do this partial asset disposition, what you're showing is basically a tax form showing that these appliances have no more tax value. Therefore, they're being taken off the books and there's no recapture tax on that amount. And so that's essentially, how it works.
So, we don't really see this opportunity very often with our clients to take advantage of this. At what threshold amount for the properties is it worth, have you found, going this extra step with this analysis?
That's a really good question. I don't know if they're what the threshold is. I mean, again, it's really going to come back to, is the effort worth, the benefit, right? Filling out these forms and doing the partial asset disposition. The advantage is that if you have the Excel forms and you have that will give you with the cost segregation, you already have kind of all those items broken out. So it's not that much more work than upon the sale to go ahead and just calculate that. And what that can do, like we said, is to reduce your taxable liability. At what point does it make sense? I guess the question is, at what point do you need those tax write-offs or getting around that recapture tax? I mean, that's really where it would make sense. So if you're talking about, 10,000, saving 10,000 or 20 or 50 or $100,000, I think that's really going to be the question on an individual basis.
Yeah, I would think that you would want to, there's several variables we'd want to explore, right? Like how much is the recapture? What is the potential tax liability? What is their tax rate? What is that client's other sources of depreciation and income? And then evaluating how much work is it going to be and where, to determine these amounts. How long have you owned the property? If you only owned it for 1 year, then, maybe the valuations haven't really diminished that much. But if you've owned it for 20 years, then you're going to probably see greater benefit from it.
Right. And the other thing to consider, I think, is really like, do you have other losses, in the current year? Meaning the other passive losses that you may have in that same year of a sale where you're going to try to use that partial asset disposition. You may be kind of churning water. You may have enough losses already to kind of offset that tax in the first place. And so it may be just like going through the extra effort to reduce that gain. But in the end of the day, you may have enough losses that you may not even need to go through those steps.
Yeah, another thing that I forgot to mention, now this isn't common, but we may see an opportunity. A lot of people talk about 1031 as a great way to defer capital gains tax. But here's another instance where, let's say you don't have rep status, you don't have short-term rentals, you may, in some circumstances, be able to use cost seg from one property to offset the capital gains from another transaction. Another
exactly
opportunity there. So, and that's why there's so many ways, especially with capital gains planning. There's just so many ways to look at the equation there when you evaluate your goals, what you have now, what you will have, what your tax rates will be. There's like a million different variables, and that's just one of the so many. So I think so for some of our clients here who aren't, I mean, some of our audience that aren't CPAs, that's why it's so important to talk to your advisor and a qualified advisor before doing any of this. We just talked to it. I got a lead from a prospect who did his own 1031, didn't ask the accountant.
Oh no.
Yeah, he just read some Bigger Pockets articles, which are good, but he made the assumption that that was a good idea, but he already had like $150,000 of suspended losses to offset the capital gains. Now he's going through all the extra effort and steps to do the 1031 exchange, and it's just it's a waste of time. So some other things that I'm also curious about, well, some other opportunities with cost seg. And here's just a little thing: is if you are with succession planning and estates and things of that nature, when someone passes away and in the last year of operations, if we were to do a cost seg, you can actually do a cost segregation study after they have passed away for that year and accelerate the depreciation in the year of their date of death, and then it still gets stepped up to fair market value when to their heirs. So if you're on the fence on whether to run one because you're losing depreciation in the future, there is no future, unfortunately, for that owner. But you also it's just another opportunity and to create some additional write-offs on that return where you're not, some of the downsides of cost seg, maybe you lose depreciation in the future. That's not really the case because it gets stepped right up to fair market value.
That's huge. Yeah. And even just kind of to go on that point for a second, a lot of people don't think about that. Like if you've inherited a property, right, you can do the step up basis, meaning you're going to be able to get the fair market value now. You can do the cost segregation on that new, even though it's been fully depreciated by whoever, bequeathed that to you, you're able to now take a cost segregation from brand new based on that new market value.
Yeah, and they have been trying to change that in proposed legislations because it is a cheat code. It's really, you want to talk about a way of creating generational wealth here. I mean, the depreciation starts right back up again, and that's when you think about the tax benefits of real estate, you can't not talk about depreciation. Mm-hmm. And on a side note, though, you don't get the bonus depreciation if you inherit it, but you're still going to see value from the cost seg even without bonus depreciation. So one thing I'm curious to know. So how long were you doing cost segregation studies before the Tax Cut and Jobs Act?
We were, yeah. I actually joined Madison and started the cost segregation about a year before that. So obviously the Tax Cuts and Jobs Act was huge. I mean, it made a very big difference, especially with the bonus depreciation, 100% bonus depreciation coming into play. So that was amazing. What was amazing to me, and especially now that we're talking about this year being the last year of the 100% bonus depreciation, is people were talking about, well, will cost segregation still be beneficial if you can't take the 100% bonus depreciation? And I'm like, our company, this has been around for decades. Cost segregation has been around for a long time. No, it will not be as beneficial, but it still will be extremely beneficial.
Yeah, and that's something that I'm really interested to see in how our planning and strategies evolve. And so maybe you're not looking at the 1040s of these clients, but I suspect what we're finding is we're still getting the properties to operate at a loss even without bonus depreciation, correct?
Yeah, absolutely. And that's really the point. Like if you can create a loss, I mean, that's really where it's going to be beneficial. And as you know, it's not going to be beneficial for everyone. Okay. Cost segregation is never going to be the right fit for every single person. But if if you can get it done on a property and create that loss, that's going to be where it's going to be the most beneficial.
Yeah. So what's interesting is what I think, for a lot of our audience, I think that right now with 100% bonus depreciation, it has opened up the opportunity for lots of people to do cost segregation and to justify those procedures. Even if you have a place that's 300 to 400,000, you still create a good chunk of losses and significantly impact your 1040. But what I think, and I'm interested to hear your perspective from what you saw before then. But what we'll likely see is the threshold by which it's worth our energy to do the cost seg, the value of that property. We're going to want to see. We're going to need. It's going to be less and less impactful on these smaller priced properties. So, in order to really see the benefit, either you're going to have to go bigger, or we're also going to have to. We're not going to see as many opportunities for some of these beginning investors who are getting properties for $200,000, $300,000, $400,000.
Right. Absolutely.
Yep. So, what are your thoughts on I imagine that after Tax Cut and Jobs Act, you saw a whole new group of investors coming through your door to talk about this stuff, and perhaps in the future, what are your thoughts on the projects we'll see and the changes we're going to be seeing in our strategies?
The biggest thing that I saw is, our threshold used to be, we used to tell people all the time, if a property is purchased for over $1 million, that's where it's going to be most beneficial. And when Tax Cuts and Jobs Act came about, and we're talking about using the 100% bonus, especially for smaller properties, and then with short-term rentals and using these strategies, I would say $500,000, like cut that in half. And the truth of the matter is, really, even if you go down to a $200,000 or $300,000 purchase price, you're still going to get a tremendous amount of benefit. Without the bonus depreciation, that's going to be much less, because again, if you're only able to take those deductions, again, we were talking about like 25%, for example, to the 5-year property. If you have to spread that over a 5-year period, the net benefit in that first year is going to be much less. Okay. And second year as well. So the threshold, like you said, is definitely going to move back up, I think.
Yeah. So for some of the audience listening and beginning investors, we have a lot of clients that are beginning investors and who are just now learning about this stuff. Like this is, and obviously I don't know what the future holds for us, but I suspect that we're going to look back on this time as a golden era for real estate investors, where we look at what you can do with short-term rentals, and you look at bonus depreciation, and there's just an insane amount of opportunity to create tax savings, especially for people who want out of the W-2 lifestyle, and they want to use these tax advantages to get additional capital and to put right back in. So for those of you guys listening, these opportunities are not going to be as incredible as they are right now. And in the future, you're going to have to, hopefully, and a lot of our clients are already moving on to bigger and more lucrative projects with more access to depreciation. They've already quit their jobs and used the tax savings, and we're working on the bigger projects. But for those of you guys who are getting started, you really want to take advantage of this time, because the time is running out. Unless we see some changes, and I don't think we will. I don't think that we're going to bring back bonus depreciation after it starts phasing out right away. But I mean, I'm not a politician.
You never know. There is a lot of, from what I've heard from a couple of people who are involved in the space, there has been a lot of lobbying to try to continue the 100% bonus depreciation. I think there's a good argument that it actually contributed a large amount to the spur of the economy, especially the spur of the real estate industry, which kind of trickles down to a lot of different industries. If you think about all the different service providers and all the different vendors and connections and property management, everything that is involved in real estate, I honestly believe, and that's one of the reasons why they introduced the 100% bonus depreciation in the first place. Because again, when you get those extra deductions, what are you doing with that? You're just putting that money back in to buy another property or to do more business or to invest more. And so that's why it was created, was to invest more in the economy. I think it did that purpose. So I see a good argument to just, continuing that, especially now with how, unfortunately, as we've seen in the past past year or so, the economy has kind of taken a big hit.
Yeah, and I mean, I would be very interested to hear what kind of conversations are taking place in the political sphere on this topic, because at least what I've seen with our ability to help our clients flourish and build their portfolios, I mean, the ability to do cost segregation and get bonus appreciation has changed their lives. So, I did a cost seg with you, Yonah, and we wrote off like 38%. It was like $280,000 of a cabin, and that client, he got a $60,000 tax refund. He and his wife had W-2s, and he quit his job. And it's not like he quit his job so he can be retired and be on the beach sipping margaritas. And he's doing multi-million-dollar projects now. I mean, he's building all sorts of properties and all sorts of creative opportunities, and he's mobilizing and inspiring other investors to do cool stuff. So it's really fun to see the impact of these tax incentives and how it helps clients and the economy flourish.
Yeah. 100%. That's amazing. That's an awesome story. And I love those stories because that makes such a huge difference for me. So I love when I hear that people are able to retire or their spouse is able to retire. And, using that strategy, especially with the spouse being the real estate professional, that's something that I've seen. And, people aren't necessarily retiring to just travel the world or sit on the beach, or whatever. They're changing professions to a certain extent, but doing something that they enjoy. And I think that's really the main difference. If it is something that you enjoy, if real estate investing is something that will give you more freedom, more financial freedom, time freedom, location freedom, these are things that a lot of us strive for. And what I've seen is so many people going down that path and being successful. So, good for them and good for you for helping them figure out these strategies that they can do that.
Yeah, and and that's what people don't realize. Like, taxes are awesome. Like, doing tax advisory, I tell people, like, you don't realize how cool it is to do what we do, where we can have these incredible impacts on the projection of people's finances and careers and life path, that they can, change their careers and adjust their life to spend more time with their children, do projects that have a greater impact on the community. It's not just about reducing taxes. We can really impact their lives. Another thing to talk about here is, what do we do after the cost seg? So we know, let's say we're in a year when we're dropping these our clients into a $0 tax bracket. That's fantastic. And if we get a refund, that's fantastic. But there's more that we can do. So one of our strategies is income shifting. So you want to shift some income into that year with the losses from the cost seg. So let's think, maybe you're thinking about selling your way out of a partnership. Maybe you're thinking, we talked about capital gains planning, combining that with cost seg. If you're in a $0 capital gains bracket, maybe you have a portfolio of stocks that we can start liquidating and take advantage of not paying capital gains tax on that. Maybe even things like installment sales. If we know for the next few years we have enough depreciation and our investment strategy will keep us at a $0 or a low capital gains bracket, the installment sale can eliminate capital gains instead of recognizing all your capital gains at once. So many different ways that we can look at this. Not only are we going to eliminate your taxes in the current year, but we can set you up for success in the future years by shifting some of those income and tax triggering events into the years of the lower brackets. So lots of cool combinations and variables that we look at with our clients.
Absolutely. No, that's a good idea. To be honest, that's really more in your boat. After the cost segregation is done, I kind of take a back seat and, wait for the next deal, wait for the next property. But obviously there's so much more that goes into it. So, kudos to you. Absolutely.
So let's talk. So here's some things I'm interested to know. Like I was talking about earlier, so let's shift our energy away from the taxes and the cost seg. And what I'm curious to know is, back to how I found you. And there's one thing that, is so unique about you is that you're just like everywhere and like everybody knows you. I'm curious, how have you built this, this name and brand for yourself? And Can you tell me a little more about like the benefits that you've seen from creating all this content and connecting with so many people?
It's unbelievable. The LinkedIn especially has been a tremendous resource. One thing that has helped me more than anything else, I think, and just the consistency of showing up every day. And I kind of took upon myself about 5 years ago and it was really on a whim. I saw some other people doing it, but it was really just to post some original content, and not just like a random link or a random article, like something that's actually thoughtful, thought provoking, whether it's a story, and stories happen to work really, really well. So like I would just post something and do that consistently every single day. So that's what I've been doing, and it just builds on itself. But another thing that has been really helpful has been guesting on podcasts. So you're kind of leveraging someone else's audience. And I like to look at Gary Vaynerchuk, Gary V, as someone I look up to in terms of his marketing strategies. I've read a bunch of his books and follow him on the social media platforms. And he is kind of prolific in saying how to do things and what to do. But more than anything, what he's talking about, if you go kind of deep and you look into the core values that he's all about, is just two things: basically listening, right? Really caring about your customers or your clients. And number two is adding value, right? That's his book, Jab, 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 Right Hook. He wanted to call it, before the publishers cut it down, like jab, 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 right? Like 20 times. And that's before the right hook, because the right hook is the sale, but the jab is just adding value, adding value, adding value. How can I do? What can I do to help you? What can I do to do something for you? And, by doing that, what you do is become someone that, like you said, just showing up everywhere, that people see you, they recognize your name, they automatically think, and that's what the branding does. They automatically see your name, they know what you do. And so my name has become synonymous with cost segregation, which, that's great for our business. And that's what I do. But really, in the end of the day, I'm just out there to try to help people in as many different ways as I can. This is one way. And this is something that obviously it's a win-win. It's our business. We have profit, we have revenue from that, but we're helping people, every single day, like save money and save taxes. And that's really what it's all about.
Awesome. And so is there anyone else that, maybe was your role model, or who you were looking to follow and modeled yourself after?
Yeah, there are definitely a lot of people, especially when it comes to like social media and marketing, digital marketing. I kind of found many people over the years that are digital marketers, and I kind of just like to watch what they do, because like every platform is different. Okay. And yeah, maybe just trying to put everything on every single platform, and that can be beneficial to a certain extent. But when you kind of hone in and figure out the platforms and figure out what works the most, the way that you do that is by following like people who are successful digital marketers, because they're bringing, they're not doing what they're doing unless it's actually bringing profit to them. Right. So you are like, okay, this is what they're doing. This is how they're doing it. The nuances, it takes time, but it's really, if you're just doing it consistently every day and kind of learning some of those nuances, it's a tremendous amount of value. So I don't know if there are any names specifically that come to mind, but definitely a bunch of people over the years. Ryan Serhant is another great example of just someone that is, Sell It Like Serhant was one of those books that I read early on. It's just, again, about just being there for other people and going out of your way to sharing stories and sharing other people's stories also.
Awesome. Well, what I'm also curious about is, so you see all these people seeing all these benefits and saving millions of dollars from the cost segregation studies. Do you ever get FOMO, and are you investing in real estate, or are you doing anything to take advantage of the tax incentives and advantages of real estate investing?
Absolutely. I wouldn't necessarily say FOMO, but I would love to be, because I really do love what I do. And so there's been a lot of, I've had conversations with myself and with mentors, like, what should I do? Is this something I should pursue? Should I go into like the capital raising? Should I go into the syndication space and become like an investor like tons of my clients are? And really, at the end of the day, I very well could do that. And that may
Yonah, I think I lost you.
Yeah, I lost for a second. My connection cut out some. But yeah, I mean, I have invested. I do invest mostly passively at this point. I've been involved on an active deal as a general partner for one multifamily syndication, a very, very minor role. So I definitely have seen the benefits. And I am a very avid proponent of of real estate investing. So big fan of real estate investing in multifamily and self-storage and mobile home communities. So definitely trying to diversify there as well.
Yeah, when I started my practice, I did it originally because I wanted to be a real estate investor, and I was part of it was I wanted to hang around other investors, and they saw I was a CPA. They're like, you must know how to save money on my taxes. I didn't. I was like, well, I couldn't see myself paying anyone else to do my taxes after all the work I went through to be a CPA. And I also discovered I was actually passionate and interested in this stuff. But now whenever I think about the opportunity to invest in real estate, and I probably will get back into it, I just have one deal right now. I also find that there's so much opportunity, and there's this infinite universe of tax saving opportunities and strategies and services we can provide our clients. It's just so exciting, and not only it's just I'll never find everything I want to find. Like, there will always be more opportunities out there, but I always find myself drawn more now to the area of helping people and improving on and expanding upon our services, and dedicating my energy towards that. And the ROI on that is just insane as well. So it's hard to find the time and energy when you find where your path is.
100%.
So I think we had a good conversation on cost segregation. Is there any other unique or nuggets or anything else you think worth talking about? I think we covered a lot.
Yeah, we did. I mean, obviously, there's so much we could cover more. But these are great tips. I think making sure you have a CPA that is looking out for your best interest and giving you these strategies to help you scale is probably the most important thing you can get out of this.
Yeah, I think also for a lot of people just assume they need a cost seg study. There's so many other things. A lot of times, obviously, cost seg is going to be incredible, but you really want to be collaborating with your accountant and planning for this. And let's say you're trying to save money on an accountant, and you order the cost seg before the end of the year. Remember, we were talking about earlier, you really want to take advantage of you being in that low bracket. You may have missed some opportunity to shift income into that year with the $0 taxes, and that time has come and gone. So, the sooner you can start collaborating with the CPA, the sooner, the better off you are to optimize your situation. Before we close out, can you tell everybody about how to find you and learn more about what you do?
Yeah, definitely. I mean, you can find me on all the social media platforms. Obviously, LinkedIn is the biggest one that I'm most active on. You can also go to YonahWeiss.com. That my website has a lot to do with what we're working on the cost segregation side, on my podcast, on real estate investing, etc. You can also go to our company, Madison Specs. And, if you want to get a free estimate for any property, happy to do that. Awesome.
Yonah, thank you so much for your time today. For everybody listening, this content, even though it's recorded live, you can still watch the replay on YouTube and on any major podcast player. You can find some of the stuff on our site, and obviously you know where to find me if you have any additional questions. And again, Yonah, thank you so much. And everybody, have a great night. And Yonah, thanks again. I don't know why. So we had like 30 people live for our short-term rental investing webinar, and I guess they're tired of hearing us talking about costing. Like, this guy, he's talked about cost seg enough. I'm up to my neck in cost seg.
That's great.
But I think that we had some good
stuff. I think anyone who listens to the replay.
Yeah, they'll get some good stuff out of them. Maybe that's what they said. Like, I'll wait for it to be on Netflix. I'll wait for it to be on the podcast. Yeah, well, that's cool. So, thanks again. And how's your week going? Everything's doing all right?
Doing great, doing great. It's been a busy time, and looking forward to tax season ending.
Same here. Except I mean, here's the thing: is this year I'm actually treating it more like a marathon, and I'm not stressing over April 15th or 18th because last year I felt like I was going to have a heart attack on October 15th.
Mm-hmm.
And I got to pace myself to get through there. So I'm actually putting more energy into recruiting talent right now and just pacing myself psychologically and physically for us with cost tags and all this stuff. It's an 8-month long busy season. So
yeah, that's true. And we're busy year round, but it's just, the stress of just getting the reports out when people need them for the tax filing deadlines has been a little stressful.
Yeah. Oh, I meant to ask you, New York City, and you live in New York City. What do you think are what do you think would those percentages, like a 25% estimate, be similar in a condo in Manhattan where the land is so expensive and the building structures are a little bit different and you don't have land improvements on a condo?
Yeah, you know what? Probably not, to be honest. First of all, the land, if it is a condo where you actually don't own any land, so that's an advantage, but at the same time, you also won't have any land improvements, right? So it's kind of a double-edged sword there. But for condos, it's like, sorry, I get a little faulty connection there, but typically condos have a little bit less personal property in them and more going into the value of the property itself, into the building structure. So I'd say it's probably more in the 15 to 20% reclassification when we're looking at condos.
Yeah. I wanted to get into New York City real estate investing demographic because you just have these massive, 15, 30, $100 million buildings. I thought it'd be really fun, but there's a barrier to entry in New York City real estate investing is so high. Yeah. And I find that most of my clients in New York make around what my clients in the Southeast and Midwest earn, and they're just paying more. So they have less money left over to invest a lot of times. So I love some of our clients in the Hudson Valley are doing really cool stuff, but in the New York City area, it's a tough market to break through.
It is a tough market.
But
there's so many different ways to invest.
Yeah. What part of town you live in? You live in Brooklyn, right?
So currently I'm actually in Israel. So that's
cool.
Kind of relocated and living, working remotely.
Oh, very cool. I miss New York City a lot. It's such an exciting place. Israel, I'm sure the weather is a lot nicer in the wintertime. That's for sure.
Yeah, that's for sure.
What part of Israel?
In Jerusalem.
Such a beautiful place.
City. Very beautiful.
Yeah. I remember when I was there and just like, I've never seen a city like that. Just how historic it was. And I ate at a restaurant. It was literally a hole in the wall, not figuratively. It was a wall with a hole, and the restaurant was in that hole.
That's funny.
Yeah. Awesome. Well, hey, thanks again. It's probably morning time where you are, right? And
either late or early, depending on how you look at it.
Okay. Well, I'll let you get back to whatever you're doing, and appreciate your time, and we'll be keeping in touch.
All right. Awesome.
Have a good one, Yonah.
Thanks so much.